Hello and welcome to this edition of the Informs Conference, where we're going to talk about the rail and rail equipment effects from COVID-19, which have been many and varied. But before we jump in, I want to introduce who I am and who I work for. My name is Todd Tranausky. I'm the Vice President of Rail and Intermodal here at FTR. I'm pleased to be here and be able to present to you today. We have a whole suite of products on the supply chain that look at particular aspects of what is going on in the marketplace, from the economy up. We look at the economic data that produces a freight forecast, and that freight forecast feeds into our equipment forecast. The equipment forecast is what I have, one of the products that I have on this slide, the Rail Equipment Outlook. That if you go to ftrintel.com/informs, you'll be able to download a complimentary copy of our latest Rail Equipment Outlook to see how we view the equipment marketplace and what we expect coming out of COVID-19. And I'm going to cover a little bit of that in my presentation today. But as I said, we look at things from the bottom up, from the economy up. So you have to understand what COVID-19 did to the underlying economy. And you can see here in real GDP, we took a significant hit, and not just a one-time hit, but a hit that will continue to be present all the way through the outer year periods. Even in 2023, we still don't get back to the trend line that we were on before the pandemic. That is key. Freight demand, equipment demand is going to be at a lower level because the underlying economic demand that supports it will be at a lower level because of the pandemic. Let's take a look at some indicators of production and trade, so the industrial economy essentially. And what you can see here is that things, they feel good. They feel good because sequentially we're up. If you look at July, you look at August, and you look at September from August, we're still getting some of these data points in. That's why I didn't update this slide through September. Otherwise, I'd have some data point through August, some data points through September. Keep everybody level set. We look just at August, and you can see we're up sequentially, but we're still down to where we were before the pandemic. And that says that freight demand is going to be lower than it was before the pandemic. The other piece of the economy that we need to think about quickly is the inventory to sales ratio. And what you can see here, the orange line is wholesale, the green line is retail, the blue line is manufacturing. Wholesale and manufacturing inventories have come down, but they're not as high, they're not as low, as retail is. They're sort of at normal post-recession levels. If you look back to 2008, 2009, if you look back to 2017, 2018, sort of the end of the transportation bull market, there you can see that we're still basically where we were before the pandemic. We haven't materially moved lower. But that green line, the retail line, not only has it come down, it's come down faster and harder than the other two. And we're at historically low levels. You know, if you pull this chart even back further, back to 1992, what you'll see is that retail is at the lowest point it has been since 1992. Todd, why did you pick 1992 as your starting point? Simple. That's the first time FTR started keeping track of that data. So that's as far back as we have. As far back in history as we have, retail inventory to sales has never been lower. That creates demand in the system. That creates pressure to get things moved into the market. But it only does so for a sector of the marketplace. You look at the carload market. This is the piece of the rail economy that's tied closer to the industrial, the manufacturing, the wholesale side of the economy. And what does it tell you? Well, it tells you that things are sort of slowly growing. They're sort of slowly moving up and to the right. But they're not moving quickly. They're not moving quickly. They're not surging back. They're not roaring back. You know, the blue line is where we are on a carload basis. The gray lines are year over year, and the dashed line is the 5-year average. And you can see we're still 30,000 carloads a week below the 5-year average. That's a significant variance, and it's a variance that's not going to go away overnight. You can see that we're still down 7 or 8% year over year. Yeah, it's better than the 10, 12, 14% we were earlier, but it's not positive. It's not growth. It's not even a flat market. Things have a long way to go. On the other side of that, the rail house, the intermodal sector, you see a vastly different story. You know, it's the same rubric as the last slide, with the blue line being carloads, the gray line being the 5-year average, and the bars being the year-over-year change. And you can see things have come back a lot quicker in intermodal than they have in the carload sector. They're moving above the 5-year average. They're moving above seasonal trend for growth right now. And the reason for that is most intermodal goods are retail goods. They're imports coming in from China. They are things that are going to end up in your Amazon distribution center, in your Walmart, in your Target, in your favorite big box retailer. And when we started this, we talked about retail inventory to sales and said how much lower that was compared to everything else. So it's not a surprise then that the freight sector most tied to that retail economy is performing the best. This is exactly what we would expect to see happen. But it means that there's a dichotomy in the marketplace. It means that intermodal is performing at a much better rate, a much quicker recovery than the carload markets are. And so when volumes come back, the question inevitably comes up, what about rail service? How quickly are my goods going to move through the supply chain? And what is that going to look like? What does that mean for my transit times? How much equipment am I going to need? Well, rail service is at good levels. Yes, it's gotten a lot of attention in the regulatory world recently with the Federal Railroad Administration, the Surface Transportation Board, each putting forward letters to the railroads that ask about their service levels. And you can see the red line in 2020, service has come down from where it was during the pandemic. But that's also a period, if you looked at this slide and the overall carload slide, you would see that trains got really, really quick about the time there was no volume on the network. Again, that's exactly what we would expect to happen. The less volume on the rail network, the easier it is for the railroads to be efficient and to move goods quickly across their networks. So it's no surprise that as volumes come back, we would expect to see service deteriorate. The important thing to take away here is that red line is 2020. The other lines on the chart, the green and the purple lines, are 2019 and 2018. The dashed blue line is the historical 10-year average. We are above, and in most cases, significantly so, above those lines. So service, while not where it was during the pandemic, is not bad. The sky is not falling. Service is an important thing to look at for the rail equipment space because every mile per hour that trains move quicker, there's 50 to 60,000 additional rail cars that are not needed in the system to move the same amount of freight. So a small change in this metric can mean a huge difference in the equipment markets. And so even though you look at it and say, you know, it's a mile an hour, maybe a mile and a half per hour quicker, that has a big impact on the equipment market, has a big impact on utilization and how much equipment we need. But the pandemic has not just altered the flow of volume through the system, it's also changed where they enter. For years, the West Coast ports have been losing market share to the East and Gulf Coast ports. And the pandemic has arrested that. The pandemic has stopped that progress. And one of the reasons the pandemic has done so is because retailers and beneficial cargo owners, in response to those low inventory levels, well, they're looking for the quickest way to get goods, particularly imported consumer goods, to their distribution centers and their warehouses to sell to customers. Well, the quickest way to get goods into the country, even with congestion, even with periodic labor issues, even with environmental mandates, is the U.S. West Coast. And so retailers and beneficial cargo owners are choosing the West Coast over alternatives that take 10 to 15 days longer on the water to reach the port, even though they may ultimately be closer to the end market. That 10 to 15 day additional transit time, even if you transload the good on the West Coast, means that it's going to not get there as quickly as if you had just come through the West Coast in the first place. And you can see the northeastern ports. I could have shown you southeastern ports. You have seen that market share had been steadily going up. Now it's not. The pandemic comes, and in the second quarter, northeast port market share goes down significantly. So let's transition and let's talk about the carload markets. The carload markets are not expected to recover quickly. We talked about that before, how the industrial and the manufacturing markets are going to be a slow pace of recovery. Well, that's exactly what we're going to see here. We see the second quarter being a huge bump up. That's because of the comparison period. The second quarter it's comparing against is when most of the U.S. economy was shut down for the pandemic. So we get into the back half of 2021, we expect to see a much more normal growth rate for carload markets with things at GDP or GDP plus growth, which is a much more comfortable place for the carload markets to operate than where we have been for most of 2020 and even the back half of 2019. When you talk about the carload markets, invariably people try to say it's a coal problem. And yes, coal plays a role, but it's not the whole story. If you look at economically sensitive freight, you can see, this pulls out the ag, pulls out the coal, pulls out the petroleum. It shows a much similar pattern to the overall carload markets. So even when you look at just the lumber and wood, stone, clay, and glass, when you look at just those sort of metals and metal products, automotive, those sectors, that it's much the same story. It's a slow, gradual increase, then a booming second quarter because of the comparison, and then a much more normal growth rate as you get into the back half of 2021. If you think about the back half of the year, the bulk goods, ag products in the short run are going to be your best hope for growth. But again, because of a comparison, because the fourth quarter of 2019, last year's harvest was not very good. We had very poor planting conditions early in 2019. We had normal planting conditions this year, and that's going to translate into much stronger growth in the back half of the year than you're going to see in a lot of other sectors. The interesting sector for those of you that look at supply chains, that look at markets, look at diversification, is going to be forest products. This is a sector where we look at it from the bottom up. From the economic standpoint, you would expect to see this number do fairly well. You would expect to see things going gangbusters. Housing has the wind at its back. Housing has record low mortgage rates, everybody working from home, realizing the need for space for a home office and all that entails, wanting to move, wanting to find a bigger house, wanting to make additions to their current house. You've also got pulp and paper in this number. With everybody staying home, you're getting a lot more e-commerce, a lot more retail demand being delivered to your house. What is it delivered in? It's delivered in a cardboard box. You need corrugated board demand. You need pulp board demand to make those boxes. You would expect to see things ramp up, but they really haven't. And this is one of those challenging sectors because of the fact that you have economic drivers, but it has not responded in volumes. It makes it very difficult to forecast. But even here, we see sort of that same pattern. We see very weak numbers until the second quarter of 2021. And then when we get back in the back half, the thing to note is because of how weak it is currently, it's very hard to get back to those GDP plus type numbers in the back half of 2021. We're at a lower rate than some of the other sectors that we cover and some of the other sectors we've talked about in this presentation. Because if you're not going to move it now when you have the economic winds at your back, why are you going to move it later on? And that has impacts for utilization. That has impacts on how much equipment is needed. This is really a glass half full, glass half empty kind of slide. Things were very ugly during the pandemic. The economy was shut down, freight was not moving, rail cars went into storage. That all is perfectly rational. But then things came back a lot quicker than expected as the economy ramped up, as freight volume came back, as service slowed down. Things came back to pre-pandemic levels fairly quickly. But as we look out over time, as we look out over the next year, they're not going to move very much. The dashed black line is the historical long-run utilization at 82%. The end of next year, we're still not at the historical long-run average. We're still below that level. But we've come back very quickly to our pre-pandemic level. So it's how do you want to view it? Do you want to say it's half full because we recovered quicker than we expected? Or do you want to say it's half empty because we're not yet back to our historical long-run average? We're not above it. We're not really generating new car demand in any appreciable way with utilization in the high 70%. So key takeaways from this presentation, the fact that COVID-19 has slowed the economy, the freight markets, and the equipment markets, and that those effects are going to be around for a long time to come. Different sectors are responding differently. Intermodal is coming back quicker than the carload markets, and that's because its underlying economic fundamentals are very different because retail inventories are so much lower than manufacturing inventories or wholesale inventories. And rail equipment, you can look at it half full or half empty. And the question is, where are we going to go from here? Are we going to get more freight demand than we expect in 2021? Is there going to be additional scrappage of equipment that's not in our assumptions? Are we going to see Washington step in and pass a cash for clunkers for rail cars type legislation that was introduced in this past session that could get some of the older rail cars out of the fleet, the old open top hoppers to haul coal that could come out of the fleet, and in turn could have a smaller fleet and a higher utilization of the remaining fleet. None of that's baked into our current assumptions that could have a dramatic effect on the utilization figure. And so it really is half full or half empty in the rail equipment space. It's really up to the viewer. And with that, I'm going to end. Feel free to reach out to myself or any member of the FTR team if you have questions. And if you want a copy of the presentation, go to ftrintel.com/informs. You can download this presentation as well as get a complimentary copy of our latest Rail Equipment Outlook report. With that, I'm going to end. Thank you for joining us, and have a great day.